All right. Good morning, everybody. A little bit of headline news that carried over into the Sunday Open was attributed to headlines on tariff focus, I guess is a good way. They're always going to find something, right? When it's time to bounce, a narrative will be applied and they'll just say, yeah, we bounced because of that. But throughout history, price does what it does, and then they will attach a narrative to it one way or the other. So that seems to be the attribution for the bounce. If it wasn't that, it would have been something else. It really doesn't matter at the end of the day who gets the credit for the bounce. They're saying it's because the tariffs may be more strategically placed rather than applied with a broad brush. But as the headlines don't dig into the details, when you do actually read any of the comments made and you get past the headlines, you'll see that even with a targeted approach, the biggest trade imbalances would account for the most damage. So it won't matter if it's targeted to only 18 nations or whatever the exact number is. It's still going to be the bulk of the trade imbalance. The damage would still be there. So we've all been waiting for the bounce. We're starting to get it. With the VC funds and CTAs adding to the buying, one of the things we want to keep an eye on is the VIX to recognize whether or not it's continuing to fade like a swag level. We got to keep it below a certain level. Otherwise, we'll lose the VC funds. They're non-discretionary traders, right? So the idea behind that is they're going to participate in the market depending on what the VIX does, and they don't get a say in it. We've made it through OPEX. JP Morgan still has to do their role, but otherwise we're done with that. We're working on getting through headlines and watching the clock, because at this point it's anything tariff related and any changes like the headlines from Friday that may inspire some confidence in the US, which is what we've lost and why we continue to fade in the markets. There are a few bright spots, some of it from the fade in the dollar and companies that make money from overseas, at least 30% of their revenue or more. If a company is getting that much from overseas trading, that can be a bright spot. And then some of the big names coming up for the next quarter's earnings should have a much cleaner earnings if, and that's the key that the headlines weren't catching on. These companies, when we start the next earnings cycle, they'll have a good earnings announcement if they have some clarity on the tariffs. If you remember, a lot of companies, they already did report a good earnings. They just didn't have a forward outlook. They either declined to give one or declined to give any hypothetical numbers on what the tariffs might do. That was Walmart's approach, right? They just said, we don't know what the tariffs are going to do, so we can't really speculate on how bad things can get. They weren't the only one. They're just the one that comes to mind. So we can continue to see good earnings, but without that forward outlook, it won't matter. So we need that clarity. You can see the top names this morning that are up. NASDAQ leading the way, close to 1.5%. The Dow near 1%. Japan up at least a quarter, and then Europe below that. Hong Kong in the negative, more than 0.5%. So those China ADRs and The China play, it's just a rotation in capital, right? When money was moving out of the US, spreading out into other nations around the world, then we were fading here. If we're going to rise here, the money's coming back in, then it's going to have to come from somewhere, right? At the end of the day, money doesn't leave the market. It just changes locations in the market. And that's because a lot of those places, as odd as this sounds, they'll pay a fine or a fee to go to cash. And so they're better off at least taking risk somewhere. Because if you think about it from their client's point of view, if you have to report to a client at the end of the year, hey, we lost X amount of money, we took some risks, it didn't work, we'll get them next year. I mean, nobody wants to hear it, but that sounds better than, hey, we went to cash and you lost this much money. No, we didn't even try to take any risk. We just went to cash and lost this much money because we had to pay a penalty. Yeah, I don't think that'll fly. So money just moves from one location to a next. Bonds, treasuries, equities. So we've got PMI this morning. We got some Fed speakers. We got some auctions. Nothing really big at this point. Later in the week, we're going to get some job numbers and some homes information. Last week, home sales and information on home builders gave us a little bit of a pop. We could get a little clarity tonight out of Japan. They did a rate decision. This is going to be the minutes from that decision. It could provide a little something. I noticed the prime minister was chipping teeth earlier today about how they were leaving all the choices on the table. So maybe we'll get a little bit more information overnight. That could affect us going into tomorrow. Could see another move up in gold if this headline out of Turkey gets any bigger. President Erdogan's major political adversary was arrested, and that could spark protests. Gold being an asset in wartime or a safe haven. Just keep your eye on that one. That could fuel another drive to the upside, which can also inadvertently push the dollar down a bit more. Dollar falling is helping, right? So big picture, this would help things. All right, we're above the 10-day moving average. This gap up and run that we started today gets us an inside day breakout on the week. So we're not only outside of Friday's range, we're outside of the week's range of last week. Put it on a weekly chart, you can see that we're just getting started. Got to say though, now that we've taken it, we don't want to give it back. Adding to this, we generally don't want to see a Monday gap up, right? It's generally not a good thing, but it depends on where you're getting the gap up from, right? If we had already run up to the highs and closed at the highs on Friday, and then we got a gap up on Monday, that wouldn't be very good. I'd be looking to short that. But this is a little different, right? We're looking at it on the weekly. We had 4 weeks of decline, and then the recovery bar, the gap up, and the continued move to the upside. Getting a gap up here is a continuation of the gap up that we got last week. So we're moving in the right direction. We've still got 5,900 as the line in the sand that we want to keep our eye on. The problem is this range that we've been in. IX10. It was a pretty wide range, about 100 points. And when you have an IX10, you want a really narrow range so you could build up a lot of pressure. This was wide enough that it wasn't building up the kind of pressure we would want to see. Still, we're getting a breakout. Now we just have to be concerned about a raid draw, right? So the range draws everybody in, then we get the raid on liquidity, and then a move in the opposite direction. So this could be a breakout of the box. It could be a start on our move towards 59, or it could be a raid into liquidity before we flip and take it in the other direction. Just start with the high of last week. Let's keep that. Don't want to get back inside of that level. $57.70. We've got the volatility trigger underneath us. We still have the 20-day moving average and 0 gamma overhead. We got 57.92 COG, 5,800, 5,811, 0 gamma, 20-day. They just kind of stack up there. This sort of velvet purple, whatever you want to call that color, that is a voodoo line. $57.86.5. Looking at overnight volume, more than 100. It's more than enough. Shows liquidity is strong. There were participants in the overnight. We had a relatively narrow IB, initial balance, from 6 to 7. Then the work started coming in after that. We began to expand. But there wasn't much of a move in the kill zone, oddly enough. The kill zone between 2 and 4. So sure, we got that initial burst there, which got us out of this really narrow range that we were in. That was the kill zone up to 4 o'clock. It's like it's just this. Still holding above VWAP. If we do start to fade back, look for the distance of reciprocation. Probably gets us down into the volatility trigger. Maybe a test of that options level. It's a volatility trigger, and it's also an options level, 57.50. I would say, though, now that we've gotten outside of that box, last week's range, we don't want to go back in it. We're getting really close to the ADR half. If we get there early enough in the day, we can go to the other side by the end of the day. I know that's not what anybody wants to hear. We wouldn't see that as bearish, though, in the big scheme of things. You know, if you think about the way that markets move, we've got to have that up and down, right? It's just, that's a healthy way that markets move. So when we broaden that out a little more and we say that we can go to the other red line by the end of the day, we don't necessarily see that as a bearish behavior, more of just following the swing from one side to the other. Even markets in an uptrend still have to have a pullback, right? Just like markets in a downtrend have to move to the upside on a pullback. But with this key level of last week's high that we've broke out of, to go to that other line today would really break what we're trying to hold. It's kind of a big deal. So from the ADR perspective, going to the other red line, that's nothing. That's just a part of market behavior. But breaking back inside of last week's range, now that we've gotten out of it, that's kind of a big deal. If we get above this red line and we don't reject there, then the continued move is to get to the other ADR line, the full one up here, 58.50. So 57.92 COG, then the ADR, round number 5800, 5811, 5832, and then 58.50. Level by level by level. One thing that we can add to all of that would be measurements of the previous day's range. We've already expanded well beyond what Friday could give us. So you could dial it in by measuring all of last week. The times when this is all you have, it's what you get. So you just measure everything that we've got from the previous week, project that to the upside. Imagine that we're tangled up on the 111. So if we can get through that, we'll continue the drive to the ADR half and then up through the levels I've already mentioned. Otherwise, we reject here, come back and retest 57.70. Like a Busby that we already did back here. This week's floor pivot, still a narrow channel, not as narrow as last week's. This is last week's, it's much more narrow, but it's still a narrow channel. Today's floor pivot is all the way down here. It went down and we went up. That's odd in pivots. I think it was that spike at the end of the day that kind of the headline run that fueled all of this that continues it this morning. Pivots don't have headlines, right? It doesn't understand anything more than the measurement that it's been given. So it uses yesterday's high, low, close. There's some math involved in that, and then we get this level. So it doesn't have anything to do with headlines. It's still a really wide channel. Seeing the pivot move down is bearish. Having price open above it is bullish. Those two kind of cancel each other out. We're supposed to hit this pivot 80% of the time. That's what we do. That's the statistic. Markets like to hit their pivot. And the fact that we're not hitting it today seems pretty obvious. We would have to get through this weekly pivot to get to our daily pivot. That seems unlikely. That weekly pivot's pretty strong. It's not to say we can't break it, but it would have to be something really negative at this point to shut off all of this bullish flow across all these different sectors, break the Mag 7, break the indexes, to break that weekly pivot to get to our daily pivot. I find that very unlikely unless we get some sort of headlines to fuel that drive. So it will be very obvious, right? It can't be something subtle in the headlines. It's going to have to be a big one. We're through the R1. In fact, we've basically opened on it, ran through R2. It's very rare to just drive all the way up to the R3. But what's more common is a trade strategy where we go to an R1 and then we head to S2. Since we've already got to the R2 and we're holding above it, we can use that for our line in the sand, but we already have that line in the sand because it's last week's high. So this is just a way of stacking them on top of each other and saying, we need to stay above R2. We need to stay above last week's high. This is going to give us an MDP, very likely. That's a missed daily pivot. And we are continuing from last week's missed weekly pivot. So last week we didn't hit the weekly pivot at all. We wouldn't count that last week. We would only count it this week. If you want to know more about those missed pivots, it's not my strategy. I don't even trade the strategy, but I do use it in analysis. You can hit YouTube or Google and just type in missed daily pivots. You'll find the guy that really highlights this strategy or this concept and learn more about how you can use that in analysis. It's been a while since we've had one of those days where we just run and run and run. Like a grind higher. We can certainly get one, especially in a negative gamma environment like we're in. All right, 58.11 cog line, or this point of control from a few weeks back. This lines up at like 58.09, 58.08, something like that. Doesn't need to be perfect. I'd rather focus on the cog line, 58.11, but it is a central point of control. It's an area to look for, but if we zoom in a little bit, see how wide this is. Sure, it's more focused right there on 58.09, but I would say this whole box is an area of concern that we're going to have to get through. So from 58.11 through 58.50, basically, there's just a lot of tracks, a lot of history here. It's going to be difficult to get through. Now, generally, if we're looking back at an old contract's footprint, we don't get too concerned about it because that contract doesn't exist anymore. But this was too close to the transition where we went from one contract to another contract that can still be an area of concern that we need to watch for. From 58.11 to 58.50, it's not that big of a range, but I think it's going to be the area we're going to fight to get through. Once we get through that, it starts to get really shallow, even all the way up into 60.20. Doesn't look like much way up there. At this point, we've got a range on the week starting now of 200 points. That's 100 points higher and 100 points lower than our current location. But this is starting now, not using the weekly expected move. Last week, we talked about the profile getting more narrow. But on this 10-day, 30-minute profile, we can see the high that still needs to be taken out, 5807. So this is now what we've got to deal with. We've got the point of control below us. It's not going to move anytime soon unless we get up here and leave a real dominant footprint up here. Say we hit a ceiling and we get a lot of volume up at this level. We're not expecting to see this move anytime soon. We chopped through this zone for days, 2 weeks. We've been cutting through that level. So we're not going to see it move for a long time, but it is underneath us, and it's been a long time since we've had this sort of setup. Right? If you go back and look at the previous morning briefings, it was over our head constantly. And we've been looking to get it brought down and for us to be above it and kind of use it as a springboard to move higher. And we haven't had that setup. So we finally got it. If we do fade to the downside and get through 5,700, then we've still got this point of control, 5670-ish. I'd say we don't want to see this get tested. We got a new VPOC from last week. Let's just kind of widen this out for a moment. New contract, new color, just to keep them different from the last one. $56.98 or $56.99. I don't think it's going to matter one way or the other. It's really close to 5,700. It's the level that we want to focus on if we break back inside of Friday's range. But to do that, we'd have to break back inside last week's range. We had a double distribution on Friday. And I think if we'd ran just a little bit longer, we would have seen a point of control against the high here. But we just ran out of time going into the end of the day. Take a look at this morning. So the volume profile and the TPO, they're in agreement. That's where the point of control is on both of these. We had a lot more volume here than we did here. A lot more volume here than we did here. And the same thing, a lot more volume here than here. This is what we would consider the trades, TPO. And this is how much volume was in those trades, volume profile. So less trades, a lot of volume in those trades. If we do begin to mean revert and go back the other direction, we'd be hitting these like falling out the top of a tree, hitting these branches all the way back down. All right, we're above the 10-day. We've poked outside of the box. A 0.5% above the 10-day moving average is kind of our line in the sand on how far away from the 10 we have to get to escape its gravity. Because if you get near the 10, just kind of chop around back and forth above and below it. And we end up just holding around that 10. We have to get far enough away from it that we can begin to really go somewhere. And we've done that. We're not overbought on the daily. We haven't moved too far, too fast yet. That is the concern, though, is that we'll outrun the 10, we'll get too overbought too fast, and we'll end up mean reverting back the other direction. So this is a nice push. We'd want to keep our eye on about 2%. If we get more than 2% away from the 10-day moving average, then we want to be a little concerned that we're getting ahead of our skis and that we could mean revert because we're getting too bought too fast. We're still below the 10-week, not even back within its orbit yet. So first, let's get to the 10-week, get beyond it, begin that expansion above the 10-week. One step at a time. So we're definitely not overbought here, not in any measure. All right, I mentioned the weekly expected move. This is the weekly expected move. It's set in stone. It's using data from last Friday. It's not using real-time options data and options average implied vol that we were looking at from the options tab. If you want that, you can always get it. You can get one for today if you wanted it, right? There's today's 37.5 points higher and lower. That's today's range for the day. For the week, that's what it is right now. 101, round up 102 points, higher and lower. But what we're looking at is what it was last week going into the close. The idea behind this is completely different than monitoring the real-time average vol and the implied range that goes with it. So 58.23, that's the edge of the week's range. It's how far we were expected to move to the upside for the entire week. Don't get me wrong, in a negative environment like this, we can make that move in a single day. We're supposed to close inside this range 70% of the time. And we've got an environment right now where we're not doing that. We're closing at the end of the week outside of the range more than we should be. So we're still in that kind of environment where iron condors are not a safe play because we're exceeding our expected moves constantly. Maybe do double diagonals, double calendars, things like that. Really cheap things like butterflies or broken wing flies, ratioed flies. So this is how things looked as we went into the close on Friday. The 9 sectors that we tend to pay attention to. Top 3 are risk on, bottom 3 are risk off, 3 in the middle are midline. If we're seeing a capital rotation, then we would expect to see more money into the top 3. More in that than in the bottom 3. So this isn't one versus the other. Growth versus value doesn't mean that one goes up and one goes down necessarily. Just that more money would be flowing into one at a heavier rate of change than the other one. Tech, software, chips, AI, data centers, quantum. we'll revisit this later in the week. But this is a 5-day change, and it doesn't reflect what we have this morning. I noticed on Trading Ticks that XLF had some of the largest dark pool last week. Let me read it the way they said it so I don't misquote it. Financial sector had the highest dark pool inflow. The S&P had the highest index dark pool inflow. And SPY had the largest dark pool trade. I mean, that makes sense. They had a list of the stocks. I can just put a picture. I'll send that out. Behind the financials, we had technology. And then, oddly enough, healthcare. So this morning, we're seeing XLF up. Bitcoin, so we've got risk. China, technology and software, the Mag 7, semiconductors, China again, growth and value up this morning. So a little bit of a rising tide scenario. We have growth and value, healthcare, staples, financials, chips, airlines, cloud computing, metals and mining, precious metals, energy. Now, it's not up enough, but mining is up. They're just coming in a little short. They get up there a little bit more, they'll also be on the list. Short list on things that are down. The VIX is down. And really, that's it. The VIX is down. We need to keep that. Don't want to see the VIX moving to the upside, changing the VC funds. There was quite a bit of China names that are up this morning, but you can look at FXI bleeding off. Looks like it's maybe just trying to close the gap from Friday. We've been saying we need to see yields go to the upside and have equity go with it, which is, that's odd. It's been a while since we've been in that environment. But with more talk of the 60-40 coming back, that'd be, the old school portfolios where you had 60% equities, 40% bonds. It was supposed to be diversified enough that if stocks were down, bonds were up. And that way your portfolio would still do kind of good in bearish market backdrop or a slowing economy, blah, blah, blah. With that in mind, if equities down, bonds up, then that would be if equities down, yields down. So when we flip that around, equities up, yields up. And that's what we have this morning. Bonds down, yields up, equities up, dollar down, gold up. Things are behaving the way that they're supposed to, which makes it a lot easier to track if things start to unravel. we would start to see equities fade, yields fade, bonds pop, dollar pop, gold drop. Kind of get the idea, right? I know it may seem like a lot if you're not used to going through these different parts and pieces. So there's that push in yields. There's that push in the ES. A little bit of move to the upside here in the dollar, but it's not participating in the run to the upside. Swag level, I think if we get above, say, 104.5 and continue to drive to the upside, dollar's going to start to be a problem. We need to stay in the range or break the range to the downside, but we don't want big moves in the dollar in any direction. Subtle moves up or down. No big sweeping drops like this. That's crazy stuff. All right, so it should be pretty easy. This is a rising tide lifting all boats. Just keep your eye on the market breadth, the sectors out there. They should all mostly be green, led dominantly by the Mag 7 and the S&P and the NASDAQ. If it starts to unravel, it'll either happen first in the index ETFs like SPY, the Qs, and or we'll lose the Mag 7, or we'll lose yields. It'll be one key piece first that starts to break, and then everything else begins to unravel with it. So, you know, those three categories, not hard to keep your eye on. Other than that, keep your eye on the headlines, because if we do get negative, it's going to have to be something really big in the news. That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.